Welcome back. First, some unfortunate news and a name that many of you are familiar with. Open Mortgage, which is a regular top 10 lender in the top 100 retail HECM lenders report, which is based out of Austin, Texas, has closed their reverse mortgage division. That was first reported to Reverse Mortgage Daily, and Open Mortgage's CEO, Scott Gordon, confirmed the news to RMD. Also, multiple sources both in and outside the company reached out to Reverse Mortgage Daily and said the company had indeed closed, but Gordon provided some clarification, saying, although Open is shuttering their reverse mortgage division, the company will be continuing to operate in the traditional or forward mortgage space. Gordon said, "We made a public announcement today that we are shuttering the reverse division. It was a very difficult decision because we believe in the product and we had some of the best reverse mortgage folks in the industry, both in ops and in the field." So what were the forces behind Open's closure of the reverse division? Lower origination volumes, also combined with lower closing to pull-through rates, made the cost to close a reverse mortgage loan too high, said Gordon, of the dynamics which led to the decision. Gordon also added, the forward side will get used to the current interest rate environment if they don't get better, but the reverse side needs significantly lower rates to make the deals workable again. We can't predict when that will happen, so we'll be closing out the pipeline in December. Open Mortgage believes that their focus on the traditional or forward side will see them through the winter and also the high interest rate environments until we have better lending conditions. And there you have it, folks, a very challenging environment for lenders in general and especially reverse mortgage lenders due to the high interest rates. And there are a lot of dynamics which contribute to the challenges that lenders face today. And for Open, they've made the decision to close their reverse mortgage division, at least for now. Hopefully, we'll see them come back in the future. Ginnie Mae's portfolio of home equity conversion mortgage-backed securities, or HMBSs as they're known, pose a significant risk to the U.S. Department of Housing and Urban Development in 2024, that according to a recent report. That risk stems from the high interest rate environment and also Ginnie Mae's seizure of reverse mortgage funding's HMBS portfolio last year. Now, that's according to a new report from the HUD's Office of the Inspector General. Now, that report details some of the biggest management challenges that department will be facing likely in 2024. The Federal Housing Administration's HECM insurance program does rely on Ginnie Mae's HMBS program to provide liquidity for lenders to continue offering the reverse mortgage loan. It's an essential part. Still, business developments that led to Ginnie Mae's seizure of RMF's portfolio do require further attention. The HMBS portfolio poses a significant risk to HUD in the current high interest rate environment. HECM originations are much more affected by higher interest rates because higher interest rates decrease the funds available to a borrower through a HECM loan. As we know, the principal limit factors. Issuers must also buy a HECM loan out of their pool when a borrower of a particular loan has taken 98% of the maximum claim amount, which does require issuers to advance the full balance of the loan before its assignment to HUD. In a market with increasing or sustained high-level interest rates, the cost of financing to fund those advances becomes increasingly expensive, said the report. At the same time, increasing rates may result in decreased new HECM originations and refinances, which are a significant source of lender income. Now, based on the information provided to the OIG from Ginnie Mae, the top 4 HMBS issuers comprise 86% of the entire portfolio's unpaid balance. In recent years, the total number of participants in the HECM mortgage-backed securities program has steadily declined, said the report. In 2019, the 2 remaining depository institutions exited the industry, resulting in Ginnie Mae's HMBS program being comprised solely of non-depository institutions. The underlying risk can be seen more clearly when you consider RMF's bankruptcy in November of 2022. The then top 10 HECM lenders' closure led to Ginnie Mae taking over their portfolio of HECM mortgage-backed securities at that time. And Ginnie Mae then took over the responsibility for scheduled and unscheduled draw requests from borrowers from RMF's portfolio and mortgage insurance premium payments and also the 98% buyouts and investor pass-through payments. That cost a total of $1.6 billion. Ginnie Mae pointed out in a budget request earlier this year that the complexity of RMF's portfolio did require an additional staff and also a budget to adequately manage the size of the portfolio, and that's only a fraction of the total Ginnie Mae portfolio itself. And last but not least, we bring you our monthly installment of Reverse Market Insights, Market Minute, with John McCue. And John has some very interesting data when you consider our current lending environment and the challenges that we face today. John, welcome. Take it away.
Hello, Shannon, and thank you for having me back again this month. Normally during this segment, I share with you endorsement and case number assignments from the previous months. But it would seem HUD is a bit behind on sharing the usual details for September, so I thought now may be a good time to review a few items about this past year. There's no surprise that 2023 has been less than stellar in terms of volume. In fact, through October, we have just over 26,000 endorsed loans. If we continue to endorse around 2,600 loans per month, that puts us as an industry of just over 30,000 loans for the year, which would actually be pretty comparable to the numbers we saw in 2019. Now, that seems like a horrible number unless we do some comparisons to previous years. In fact, in 2021, for example, if we don't include HECM and HECM refinances and only look at new equity takeout and HECM for purchase, there were only 28,645 loans. And in 2022, that number rose to 35,838. However, when we look at 2019, which it appears will be our best comparison year, there were only 29,994 loans that were not refinances, and refinances regardless only added another 2,426 units. In 2023 through August, we have just over 2,000 refinance loans, and total, including those refinance loans, because again, right now HUD hasn't broken these out, but through October, total volume is 26,103. Now, I do believe that will beat the new loans from 2019, but it might be a little harder to beat those refinance numbers due to the interest rate environment that we're in. These numbers are important because it is as close to a comparison as we have for the last few years when we don't include refinances, because that is what we have been battling this year. Refinances are tough. So as bad as you think this year has been, we're actually pretty much in line with the past several years in terms of new customers. The amazing thing about the status quo is that we're staying status quo, even in this tough rate environment. We are finding ways to close loans, and this is important to remind ourselves of because what the data shows us is that HECM for purchase and new equity takeout is much less rate sensitive than HECM to HECM is. As we stay in this high rate environment, I believe more and more of you will continue to find new ways to help people. So the question is, what are you doing differently now to increase your volumes for 2024 and beyond? And waiting for interest rates to come down is not a strategy. Higher rates should be a catalyst to strengthen relationships with realtors who are looking for more ways to help their clients and even find new clients. Realtors are also very rate exposed, so find the ones to partner with that are interested in creating new transactions that otherwise would not exist without the use of HECM purchase. Higher rates should also be a catalyst to strengthen relationships with financial advisors, especially when it comes to how the line of credit works or just gaining access to more capital for clients. So in short, I hope this month's Market Minute has given you some insight and even some hope that things are not so much worse than years past. The only piece that has suffered is the refinance number, but that is okay because those are not gaining us new clients and aren't pushing the industry forward. Tune in next month as we hopefully resume to our normal format for the segment.
And that concludes another episode of HECMWorld Weekly, our video edition. We're also available for our audio podcasts on Spotify, Apple Music, Podbean, and of course at HECMWorld.com. If you enjoyed today's episode, be sure to hit that like button. It helps improve our ranking in YouTube search and their algorithm. And also you can share this video with others on your LinkedIn profile. We appreciate that. Have a great week and be sure to return next Monday for more reverse mortgage news, whether you're listening or watching here at HECM World.